Hello, and welcome. Today, we're demystifying one of the most significant accounting standards to hit the financial world in recent years, IFRS 9, Financial Instruments. If you've ever wondered how banks and companies account for loans, investments, and derivatives, this is the standard that provides the answers. It fundamentally changed how we recognize and measure financial assets and liabilities, and it's built on three core pillars. The first and most critical part of IFRS 9 is deciding how to classify a financial asset. This is done using a two-part test. The business model test: how does the company manage its financial assets? Is the goal to hold them, to collect contractual cash flows, to sell them, or to do a combination of both? The contractual cash flow characteristics test, SPPI, are the contractual cash flows of the asset, solely payments of principal and interest. Based on these two tests, a financial asset is placed into one of three categories. Amortized cost, for assets held to collect contractual cash flows that pass the SPPI test. Think of a simple loan. Fair value through other comprehensive income, FVOCI, for assets held for both collecting cash flows and selling, that also pass the SPPI test. Fair value through profit or loss, FVTPL. This is the default category for all other financial assets, including those that fail the SPPI test, like complex derivatives. This principles-based approach replaced the more complex, rule-based system of its predecessor, IAS 39, providing a more logical framework for financial reporting. This is perhaps the most revolutionary change. Under the old rules, companies only recognized a loss on a financial asset when it was incurred, meaning a default event had already occurred. IFRS 9 introduces a forward-looking expected credit loss, ECL, model. This means companies must now estimate and provide for potential future losses on their loans and receivables. The ECL model is a three-stage approach. Stage 1. At initial recognition, a company accounts for expected credit losses that might occur within the next 12 months. Stage 2. If the credit risk of the instrument has significantly increased since initial recognition, the company must now recognize lifetime expected credit losses. Stage 3. When a financial asset becomes credit impaired, i.e., a default event has occurred, the company continues to recognize lifetime expected credit losses and calculates interest revenue on the net carrying amount. This shift ensures that financial statements are more forward-looking and provide a more timely picture of credit risk. Finally, IFRS 9 reformed hedge accounting to better align with a company's risk management strategy. Hedge accounting is an optional tool that allows companies to match gains and losses on a hedging instrument, like a derivative, with the losses and gains on the item they are hedging. IFRS 9 makes it easier to qualify for hedge accounting by focusing on the economic relationship between the hedging instrument and the hedged item. This new, principles-based model simplifies the process and provides more useful information to investors about how a company is managing its risks. IFRS 9 is all about providing transparent and useful information to users of financial statements. From a logical classification system to a forward-looking impairment model and an improved hedge accounting framework, it aims to give a clearer picture of an entity's financial health. Thanks for watching. We'll see you next time.